So what are the biggest, most powerful lessons the stock market has ever taught us? Well, to find out, we're going to take a journey back in time, nearly a century actually, because the lessons from the past, they are absolutely the key to figuring out the markets of today.
You know, this is the classic tightrope every single one of us walks as an investor, right? We're all chasing those amazing rewards, but we're also trying not to fall off the wire because of the risks. So how do we do it? The answer, believe it or not, is by looking backward. History gives us an incredible roadmap.
All right, so before we dive into all that juicy history, we've got to make sure we're all speaking the same language. And the most important word in the entire investing dictionary is return. It sounds simple, I know, but really getting it, that's the foundation for everything else.
Okay, so when we talk about a return, it's not just about, the stock price going up. That's only half the story. It's really a two-part deal. First, you've got the income. That's the cash that actually lands in your pocket, like a dividend. And second, you have the capital gain, which is just the fancy term for the price going up. You put those two together, and that's your total return.
Let's make this super concrete. It's actually really simple. Imagine you buy one share of a stock for 37 bucks. During the year, the company sends you a check, a dividend, for $1.85. Nice. On top of that, the stock's price itself climbs up to about $40. So you've got that $1.85 in cash, plus the stock is now worth $3.33 more. Add them up, and your total return is $5.18. See? Simple.
Okay, now for the fun part. Let's take that idea of return and apply it to an epic 90-year-long investment race. We're going to start the clock way back in 1926 and see how different kinds of investments did over the long haul. And let me tell you, the results are pretty mind-blowing.
So, who's in this race? Let's meet our contenders. First up, we've got the heavyweights, large company stocks. You can think of these as the S&P 500. Then you have their smaller, scrappier cousins, small company stocks. Then we have the steady Eddie types, high-quality corporate bonds, and of course, U.S. government bonds. And finally, in the super safe lane, we have U.S. Treasury bills.
So here's the thought experiment. What if, way back in 1926, you could have invested just one single dollar, a buck, into each of these categories? What do you think that $1 would have grown into by the end of 2019? Take a guess. The answer is going to surprise you.
So when we fast forward all the way to the finish line, wow, the results are they're incredibly clear. And they teach us our very first and maybe the most important lesson from all this history.
I mean, just look at these numbers. It's not even close. The super safe T-bills, they plodded along at about 3.4% a year. But stocks, they were on a rocket ship. Large stocks averaged over 12% a year, and those smaller, riskier stocks did even better, at a whopping 16.3%. This right here is the first major secret of investing. So that extra juice, that bonus return you get from stocks compared to the super safe stuff, yeah, that has a name. It's called the risk premium. You can think of it as a reward for your bravery. It's what the market pays you for taking on the uncertainty of owning stocks instead of something totally risk-free. And this number right here, 8.7%, that's the whole ballgame. On average, for almost 100 years, you earned an extra 8.7% per year just for being willing to own big U.S. stocks instead of hiding your money in the safest place possible. That is the reward for taking a calculated risk.
But you knew there was a but, right? There is no such thing as a free lunch, especially in finance. That incredible reward we just saw, that risk premium, well, it comes with a pretty steep price tag. And that brings us to our second huge lesson. So you might be thinking, okay, I get it. Small stocks are awesome. Why not just go all in on them and get rich? And that's a great question. But the answer lies in that price you have to pay, the risk you have to be willing to live through to earn those big returns.
Okay, check out this chart. This basically shows you how bumpy the ride was for each of our racers. And the measurement for bumpiness is called standard deviation. Look at the T-bills, a tiny 3%. It was a smooth ride. Now look at stocks. Large stocks were way more volatile at almost 20%. And small stocks? That was a full-on roller coaster with a standard deviation over 31%. Higher returns meant a way, way wilder ride.
So what is this standard deviation thing anyway? Don't let the fancy name scare you. All it is a way to measure volatility. It's a number that tells you how much an investment's returns tend to bounce around its average. A low number means things are pretty predictable. A high number, that means you're in for some wild swings, both up and down.
To really bring this home, let's stop talking about stats and talk about something real. Let's talk about 2008. In that one year, the S&P 500, our big company stocks, lost more than a third of its value. That's not a number on a chart. That's a real gut-punching loss that a lot of us still remember.
And it gets worse. That wasn't just a quick dip. If you look at the whole period, from the peak in late 2007 down to the bottom in early 2009, the market was literally sliced in half. 50% gone. That right there, that is the volatility price you have to be willing to pay for a shot at those higher returns.
Okay, so we've established two huge lessons. One, you get paid to take risks. And two, that risk can be, well, pretty terrifying. That brings us to our final and maybe most practical lesson from history. Can you actually outsmart this whole system?
Think about how fast news travels today. Imagine a company's stock is just chugging along at $140 a share. Then, out of nowhere, bam! Some amazing, unexpected good news gets announced. In a modern market, the price doesn't slowly drift up. It happens almost instantly. The price jumps to its new fair value of $180 as millions of people process that new information all at once.
This lightning-fast reaction is the core of a really big idea in finance. It's called the efficient markets hypothesis. And what it basically says is that all the known information about a stock is already reflected in its price. By the time you read about it, it's already in the market. This makes it incredibly hard to find a stock that's a bargain.
And this is where a lot of people get it backwards. They see a stock price jumping all over the place and think, wow, the market is so irrational and crazy. But according to this theory, the exact opposite is true. Those price jumps aren't chaos. They're the sign of an efficient market, constantly and instantly reacting to the never-ending flow of new information.
So what's the bottom line for you, the investor? Well, first off, it means trying to outsmart the market by digging up old news is probably a waste of your time. Second, that trade-off between risk and reward we talked about, it's very, very real. The best plan is usually to figure out how much risk you're comfortable with, build a portfolio that matches it, and then have the discipline to stick with it.
Which brings us to the end. You've probably heard the saying, history doesn't repeat, but it often rhymes. And that's the perfect way to think about this. The exact events of 2008 or 1929 won't happen again. But the fundamental lessons about risk, about reward, about markets, they are going to keep rhyming for as long as we have markets. So the real question isn't about the past, it's about the future. Are you ready for the rhyme?